Welcome to week 13. We are now 75% of the way through our semester and through our course material. So today we will be going through chapter 13, but before we do, let me just cover a couple of things. We had our video number 3 discussion, which was due on Sunday. So hopefully you've participated in that. I'm trying to catch up and respond to each student's main post. Give me another day or two to get that done, and I will be grading that shortly as well. If you didn't get your posts in, the sooner the better. So I also wanted to share with you an announcement I just posted moments ago about internship opportunities. Some are paid internships, some are unpaid internships. If you're interested, there is a link to a form that looks like that. And you can fill that in, and Belen, who's the director of our Career Hub for Hartnell, will be in touch with you and try to match you up with an internship opportunity. If you're not interested in an internship, the Career Hub, if you go to their website, they also have a job board called here, the Panther Job Board, which is pretty darn impressive. Oh, I guess I have to click again. It pulls in jobs from local employers that are specifically trying to recruit from Hartnell, but it also links into Indeed, so you have all those jobs available as well. And it also ties into your academic courses that you've completed. So if a job requires certain skills or knowledge that you have demonstrated through some of the courses you've taken at Hartnell, it connects those and it helps link you up with those particular jobs. So it's a pretty neat job board on the Career Hub's website here. There are a bunch of recordings to workshops related to internship opportunities. You see work on campus. What else did they have? Oh, somewhere I've lost it. Somewhere where is it? Oh, you know what? If you go to Duo, let's do it that way. If you go to Duo and log in, maybe I could have done it from here. No. Oh, here it is. Back under the job board, if you go to dashboard, because I have to log in there. Okay, let's go through Duo. Duo, job speaker, Duo again. Okay, now when that comes up, you go to the Learning Center, it's pretty cool. There are all these different videos about how to search for a job and how to interview and things like that. So it's pretty cool. I would encourage you to create a profile in the Career Center, search for some of the jobs and internships that are available, take advantage of the workshops that are available. So if you're interested, a lot of great resources for you. Okay, so again, you can either get there through Duo and then click on Job Speaker, or through this link in the announcement. There's one link to the interest form for internships, another link to the general Career Hub website. Okay, so check that out. Let me know if you have any questions. I also want to spend some time today talking about our upcoming course project. It's due May 14th. That gives us about 3 weeks almost. So you're going to want to start thinking about that and doing some of your research. Let's go through the chapter first, and then I will try to remember to come back and talk about the course project. Okay, so I'm going to close out some of these extra pages, and let's get to chapter 13. Chapter 13 is not going to take us that long, maybe an hour to go through. And so we should have plenty of time to talk about the course project. Okay, so let's go ahead and go to chapter 13. This is on long-term liabilities. We already learned about current liabilities, which include things like accounts payable, unearned revenue, taxes payable. But now we're going to focus on long-term liabilities, which is basically bonds and long-term loans. And these have some special characteristics. So we're going to learn about how to amortize them, for example, which is basically how you spread out the expense over a number of years. What else are we going to learn about? We'll learn about bonds, how they're priced, for example. So let's get into it. You might recall that the purpose of long-term liabilities is when you need to borrow money in order to fund long-term assets. So you wouldn't issue bonds or take out a long-term loan to fund short-term needs, right? That wouldn't make sense. So long-term liabilities are to fund long-term assets. Okay. Let's go ahead and get started here. So exercise number 1 is a loan situation where a company has borrowed $30,000 from a bank. And what we need to do is amortize the interest and principal over that life of the loan. In other words, we have to figure out how much of the company's payments are going towards interest and how much are going towards principal. In this example, it's a $30,000 loan, so the principal that needs to be repaid is $30,000. It's a 4-year note, meaning that the company is expected to repay the loan in 4 years. The interest rate is 4%, and it's compounded annually. That means that the first year, the company is going to get charged 4% of the original principal balance. The next year, they're going to get charged 4% of however much principal is left over. And then the next year, again, 4% of whatever principal is remaining. And then in the final year, 4% of the final principal balance. As opposed to simple interest, in simple interest, you would get charged a certain percentage of the original principal, and then you would pay that amount every year, and then maybe just pay the principal at the end. But if it's simple, that means that it's not compounding, so you're not being charged interest on the unpaid interest. In exercise number 1 here, the interest every year is being paid every year. So really there is no opportunity for it to compound. But imagine you took out a credit card and you charged up $1,000, and then you got your bill in the mail and it says minimum payment due $35. And so you sent in $35. Well, since you didn't even pay enough to cover the interest, you still owe the full principal balance, plus you owe whatever the interest is going to be that's unpaid, and that unpaid interest is going to get charged interest. Let's just think about it for a moment. Let's say it was a 20% interest rate on that credit card. $1,000, 20% of that would be $200 for the year. If you divide that by 12 months, okay, then it's coming out to what? Less than $20, maybe like $17 or $18. So I guess $35 would cover more than just the interest that's due at that time. But let's say you only paid $10 because the credit card company said you could pay just that. And your interest was $18. Okay, well, in that case, there's $8 of unpaid interest from that first month. And then since you didn't pay all the interest, the next month you're going to get charged interest not only on the principal, but also on the unpaid interest. So you want to avoid compound interest if it is going to increase how much you're going to pay overall. So if you're not paying at least the minimum interest, you don't want it to compound. On the other hand, if you're an investor and you're investing in something that's giving you compound interest, that's good, because that means your interest, if you don't take it out, is going to be reinvested and it's going to grow faster and you'll earn interest on your interest. Okay? So we don't really need to get into that level of analysis here with this chapter. I just wanted to explain what compound interest was. And that's what we have in this case. We do have compound interest, okay? And the bank has already figured out the amount of the payments. They are going to be $8,264.70. So the beginning balance is $30,000 of this loan. That's how much the company borrowed. Its payments every year are going to be the same. This was figured out again by the bank. We don't have to figure this out, and it would be kind of complicated to figure out exactly how much you would need to pay to cover the principal and the interest. So you would use software to calculate that for you. And in this case, the information is given to us. So to pay off that $30,000, the company is going to make 4 payments of $8,264.70, just out of curiosity. The company is going to pay a total of $33,058.88. So really what that means is they're repaying the $30,000 in principal, and they're paying an extra $3,058.80 in interest. But that's just for curiosity's sake. To amortize the loan, we don't need to worry about that. All we need to do is figure out how much interest and how much principal is paid out of every payment. The way we do that is we need to know the interest rate of 4%. So we take the beginning balance of $30,000, multiply it by the 4%, and we see that out of this first payment, $1,200 is going towards interest. The rest of that payment is going towards principal. So to figure out that amount, we take the payment of $8,264.70, subtract the amount that went to interest. The difference is what went to principal, $7,064.70. Okay? So we take the beginning balance times the interest rate. That gives us the amount that went towards interest. Subtract that from the payment. That gives us the amount that went to principal. Then we subtract that amount that went to paying down the principal from the beginning balance, and that gives us our ending principal balance. So $30,000 minus $7,064.70 leaves us with an ending principal balance of $22,935.30. That ending principal balance becomes our beginning principal balance for the next year, and we repeat the same process. So we take that number, multiply by the 4% interest rate we're paying, and that means in the second year, $917.41 is going towards interest. We subtract that from the payment amount. Oops, clicked on the wrong thing. And we get a principal payment of $7,347.29. We subtract that from the beginning balance. So that gives us an ending principal balance of $15,588.01. Again, that becomes our beginning balance for the next year. We take that and multiply by the 4% interest rate. $623.52 is going towards interest. Subtract that from the payment. $7,641.18 is going towards principal. Subtract that amount from the beginning balance. Okay, Trav, slow down. Let's try it again. 15,588.01 minus principal amount. That leaves us with an ending principal balance of 7,946.83. Again, that becomes our beginning principal balance. Now, notice that in the final year, we only owe 7,946.83 in principal, but our payment is more than that because the payment includes the interest. So let's figure out what that interest is. Then we multiply the principal balance times the interest rate, 317.87. When we subtract that interest from the payment, the amount that's going towards principal is 7,946.83. That is exactly our remaining principal balance. So that brings us to exactly a zero balance. So because the bank provided us with an amount that happened to get us exactly down to zero out of 4 payments, covering both the principal and the interest, it worked out perfectly. Okay? So that's how you amortize a loan. Again, we didn't have to figure out the bank or the payment amount. The bank figured that out for us, and it all worked out very nicely. Oh, let me point out as well, obviously we're starting by owing $30,000. As we pay down the principal, that goes down, eventually gets down to zero. Again, the payments were even, same amount every year. However, you'll notice the amount that went towards interest is decreasing every year, and that's because it's a percentage of the principal balance, which is also decreasing every year. And that means out of our even payments, the amount going towards principal is increasing every year. So this is how a lot of mortgages work, car payments, if you ever take out a loan for a car, which I generally don't recommend, but if you have to, you have to. That's how those typically work. They spread it out so that you're making even payments, but initially more of your payment is going towards interest, and then over time, more of your payment is going towards principal. Because of that, if the loan allows you to, because some loans don't, but if the loan allows you to pay it off early, that's going to save you interest. So the sooner you pay off the principal, the sooner you don't have to pay interest anymore. Okay, so that's exercise number 1. And I don't see anybody on this call yet. I'm not going to ask if there are any questions. And we'll move on to number 2. In number 2, we're getting into bonds. Remember, bonds are another type of long-term liability because when a company issues a bond, they are borrowing money from the investor, the bondholder. So the bond issuer sells the bondholder purchases the bond, and the bondholder is making a loan. So if you buy a bond as an investor, you're making a loan to that company or that government entity that issued the bond. They have to pay you back at some point in the future, and typically with interest. So some investors like to buy bonds because they're fairly safe. As long as the company that you're lending money to doesn't go out of business, you know that they will repay you the amount that you invested, and you're also getting interest. So they tend to be safer than stock. With stock, you might get dividends, but you might not. You might be able to sell the stock at a profit, you might not. And there's no guarantee that you're ever going to make back your investment. So bonds are typically safer than stocks, but of course there are exceptions. There are some risky bonds out there, and there are some fairly safe stocks as well. Okay, so again, bonds are long-term liabilities for the issuer of the bond. And here we have a company that issued 10-year bonds. That means they need to be repaid in 10 years. The face value is $100,000. That is the amount that has to be repaid back at the end of the 10-year period. They have a stated interest rate of 3%. That means that the company has stated that they're going to pay 3% of the face value every year in interest payments. Now, the market rate is 4%. That means that you could go buy a similar bond, a bond by a similar company in size, similar in how financially stable the company is, probably similar industry. So a fairly similar bond, similar length of time for the bond would be another factor. So you go out, you buy a similar bond out in the marketplace, and you'll get 4% because interest rates have gone up. So why would you then buy this company's 3% bond? You wouldn't, unless the company gave you a discount. So when a company's bonds have been approved, because you have to get approval from the state in which you incorporated. And when you get approval to sell a bond at a certain interest rate, and then interest rates change, so other companies are selling similar bonds at a higher interest rate, the only way you can get people to buy your bonds is if you discount the price. Now, the other thing could happen too, where interest rates fall, and that means your interest rate that you got approved at is better than what similar bonds are paying out in the market. And in that case, you could charge a premium for your bonds. But in this case, the market rate is higher than the stated rate, so you'd have to sell the bonds at a discount. So and that is the answer to the second part of the question, discount. Let me sip a little water here. And now we'll answer the first part of the question. What is the sales price of the bonds? To figure that out, we take the face value of the bonds, the amount that they're going to pay back in the future. We multiply them by the percentage that they're being sold at. So notice it says the bonds were sold at 87.5. It doesn't say percent, but we just have to know that that's what that means. That's just bond speak. That's the way bond traders talk. So if bonds were sold at 87.5, that means they were sold at 87.5% of the face value. So if we take the $100,000 face value, multiply it by 87.5%, we get 87,500. So that is how much money the company collected when it sold these bonds at a discount. Okay. Number 3 has 10-year bonds, face value $100,000, stated rate of 4%, market rate is 6%. So this is where you'd have to, wait a minute. No, you would still be at a discount. Okay. So notice though, it says interest was paid semi-annually. So that is typical for bonds. Usually the interest is paid semi-annually. Sometimes it could be quarterly or annually. But if it's semi-annually, you have to figure out what is the annual interest rate and then divide by 2, since the company is going to make 2 interest payments every year. Okay. So that's what we have to do here. The interest payments are going to be, we take the face value of 100,000 times the stated interest rate of 4,000. So that's $4,000 a year in interest, divided by 2 because the payments are semi-annual. So the interest payments are going to be $2,000 every 6 months. The face value is the $100,000. So after 10 years, since it's a 10-year bond, the issuer of the bond is going to have to repay the $100,000 to the bond holders. So in other words, when the bond matures after 10 years, the bond purchasers get their money back. In the meantime, they were collecting interest, which is great, and then they get their money back. Now, the last part asks, would an investor be willing to pay more or less than the face value for this bond? Well, since an investor could go out and get 6% on a similar bond in the marketplace, and this bond is only offering 4%, it would have to be sold at a discount, just like the last one. So the investor will pay less than face value because the market rate is greater than the stated value. Okay. All right, moving on to number 4. This company issued 5-year bonds. Sorry, I lost my cursor there for a second. 5-year bonds. So they will pay the bond purchasers back in 5 years. The face value is 200,000. Stated interest rate is 12%, semi-annual. The yield is 10%. We don't really need that, but just so you know what it means, it's if you take the actual amount the investors paid, what interest rate are they getting based on that? So not based on the face value, but based on what they actually paid. That's called the yield. So these are 12% bonds because they're going to pay 12% of the face value in interest, but that's only 10% of what the investors actually paid. And that's called yield. Yield. Okay. And it says the bonds were sold at 107.732. Again, that is a percentage. That means they were sold at more than 100% of the face value. This is what happens when your bonds are paying more than the market rate, and you can charge a premium and you can sell them for more than the face value. So what is the selling price of these bonds? Well, we would take the face value times 107.732%. Hello, Jane. And that means the price of the bonds combined is $215,464. Okay, that's probably not one bond. It's probably, you know, if the face value is $200,000, it could be $200,000 bonds. It could be $10,000 bonds. So we don't really know how the distribution of the bonds is. We're just looking at the combined face amount and the combined cost. So the selling price combined is $215,464. Were they issued at a discount or a premium? Well, we know it's a premium, right? Because they're being sold at more than 100% of their face amount. So the answer is premium. Okay. All right, so Jane, welcome. we're talking about long-term liabilities today, which includes both long-term loans and bonds. And we just finished number 4, so let's go on to number 5. All right, here we are going to amortize a bond. Now, earlier we saw the amortization of a loan, and this has got some similarities, but also some differences. So let's see what's going on here. It's $100,000 face value. The bonds pay 9% per year. They're 5-year bonds. They were sold for $96,149. So they were sold at a discount because the market rate was 10%. So the market was paying more than what we were offering. That means we had to discount the price of the bonds to get people to buy them. And the interest payments are semi-annual. So we're going to amortize only the first 3 payments. It does say round to the nearest dollar, so that's what we'll do. And this is how you do it. When you're, okay, let me just explain how this works. Bonds require the payment of interest. That interest payment is an expense for the company, right? So it's kind of like when you buy an asset and that asset depreciates over time, and you could take that as a depreciation expense. And we learned that with intellectual property, like intangible assets, you amortize that expense over time. And that's basically what we're doing here. We're taking the interest expense of this bond and we're amortizing it over time by figuring out how much interest expense we have, but we also have to amortize the discount or the premium as well. Because if we have a discount, that creates additional interest expense for us. If we sell the bond at a premium, that means we collected extra money, so that reduces our overall interest expense. So the discount or premium has to be amortized along with the interest expense. So that's what we're going to do here. Now, there's a simple way to amortize. We'll see a little bit later. Right now, we're going to do the effective interest method. Effective interest method of amortization. What we do is we start with the price of the bonds. So these bonds were sold at $96,149, right? Even though it was $100,000 face value, the amount we charged was less because we sold them at a discount. And that is our beginning carrying value. Then what we have to do is figure out how much interest did we pay our customers every 6 months. So to do that, we take the face amount, $100,000, times the annual interest rate, that's the stated rate that we stated we were going to pay. That's $9,000. However, since they're semi-annual payments, we have to divide that by 2. And that means we are paying $4,500 of interest to our investors every 6 months. So let's go ahead and put that here. That is the actual amount that we pay out in cash to our investors. Then we have to figure out the interest on the carrying value. So the way we do that is we take the carrying value and we multiply it by the market rate. Not the stated rate, but the market rate of 10%. Okay? So let's do that. We take the carrying value times the market rate of 10%. Again, we need to divide by 2 because we're making 2 payments a year. So we need to amortize twice a year. So that comes out to $4,807. That is the interest on the carrying value. So since we really only paid $4,500 of interest, but the interest on the carrying value is $4,807, we take the difference, and that is the amortization of the discount. Okay? Now it's a little complicated, but the difference between the first two columns is the amortization of the discount. Now that number we're going to add to the carrying value, because by the time the loan matures, the carrying value will get up to the face value. And that'll show that we've fully amortized that loan. We amortized the discount and we've paid back the face value, and at that point, the loan is off of our books. But first we have to get it up to the face value before we could do that. So the next step is we add the amortization of the discount to the carrying value. That's $96,456. And then we repeat the process. What was the process again? We take our carrying value times 10%. That's the market interest rate, divided by 2. 4,823 is the interest on carrying value. Again, we take the difference between that and the interest we paid out, which comes out to $323. We add that to our old carrying value to get our new carrying value. 96,779. And again, we repeat the process. We multiply that by the market rate, 10%, divide by 2, 4,839. The difference between that and the cash interest payment is $339. And again, we add that number to the carrying value. And we get 97,118. So if we were to amortize all the payments for that loan, we would keep going until, since it's a 5-year bond and we're paying out interest twice a year, it would be a total of 10 interest payments. And by that time, the carrying value would get up to the $100,000 face value, and then we would return that $100,000 to the bond purchasers. Okay, so that's how you amortize a bond. Now it's a little bit different if the bond was sold at a premium. The difference is that you would subtract the amortization of the discount from the carrying value until the carrying value, which would start out at more than the amount of the bond, right? Because of the premium, you keep subtracting the amortization of the premium until you get down to the face value. Okay, so if the bond has been discounted, you add the amortization of the discount. If the bond is being sold at a premium, you're going to subtract the amortization of the premium. Otherwise, the process is the same. Okay, so number 6. That's exactly what's going on here. The bonds were issued for $700,000 and the price was more than that, so that included a premium. The stated interest rate is 5%. They're 10-year bonds. The market rate is 4% and interest is paid semi-annually. Okay, so this one I'll go through a little more quickly, but again, it's very similar to what we just did. We're going to start off with our carrying value. We're going to we should figure out the cash interest payment. I forgot that part. Let's do that. To do that, we take the principal, the face amount, times the stated interest rate, and then divided by 2, since there are 2 payments a year. That's $17,500. That is the amount we will pay the investors every 6 months. in interest. Okay. So that part's pretty simple. Face amount times the annual interest rate, and then divide by the number of payments per year. Then we have to figure out the interest on the carrying value. So again, we take the carrying value, which starts with the amount that the investors paid for the bonds. We multiply that by the market rate, which is 4% in this case. And again, divide by 2 since we're doing this twice a year. And that starts us off with 15,145. We subtract that to get the difference with the cash interest payment. That's a difference of 2,355. Now, we then are going to subtract that from the carrying value, right? Because that carrying value is more than the face value. So we're going to subtract the amortization of the premium until we get down to the face value. Okay, so I think I got that right. Let's just double check, because yesterday in class I goofed it up a little bit with my face-to-face class. But yes, that is correct. So I'm going to keep going. What I did yesterday is I added the amortization of the premium. Even though I knew I needed to subtract, I forgot, because in the last exercise we were subtracting, right? But now we need to add. So I need to remember to do that. So remind me if I goof it up again. Okay, so then again, we're going to continue the process. We're going to multiply by the interest rate, the stated rate of 5%, divide by, the market rate. See, I just goofed up again. Okay. So carrying value times the market rate, divide by 2. That's 15,098. We take the difference between that and the cash interest payment, 2,402. And then again, we subtract that from the carrying value. $752,486. Okay, and we multiply that by 4%. Divide by 2, 15,050. Let's just double check, make sure we're on track here. Yeah, 15,050 looks good. Subtract that from the cash interest payment, 2,450. And again, we are going to subtract that from the carrying value. $750,036. Okay, and then we keep going, right? So I'll just keep going here. Times 4%, divided by 2, 15,001. Subtract that from the cash interest payment, 2,499. Subtract that from the carrying value, 747,537. And we keep going. We multiply that by 4%, or divide by 2, 14,951. Subtract from the cash interest payment, and we get 2,549. Subtract that from the carrying value, 744,988. And one more line times 4%, divided by 2, 14,900. And that's a difference of $2,600. Subtract that from the carrying value. And we get a final carrying value of 742,388. Okay. Again, if we kept going all the way till the end, we would get to a $700,000 carrying value, at which point the loan is fully amortized and we would pay back the principal. I mean, it's a bond, not a loan. We pay back the principal on the bond. Okay, good. We did end up with the right number, but we're going to stop there at the end of year 3. So that's a 10-year bond. So if you had to keep going and do all 10 years, it would take quite a while, right? That's why we have spreadsheets and software to do some of this for us. Okay, so that was a little time consuming, but we can now move on to number 7. And don't worry about the spacing here being kind of off. So there we go, just fix that. Okay, question number 7. This company issued 100 bonds, face value of $1,000 each. So they sold the combined bonds for $104,000, even though the face value was $100,000. So the question here is, how do we journalize it? Well, the company received $104,000 since that's what it sold the bonds for, right? And the bonds, there are 100 of them, and they each have $1,000 face value. That means they have a combined face value of $100,000. So the difference is a premium. That's extra money we collected from the investors for the bonds. And that is a credit to premium on bonds payable. It's a premium we were able to charge on the bonds that we have to repay. All right. So going on to number 8, this company issued $90,000 in bonds for $87,000. So those bonds were sold, at a discount. They had an interest rate of 8%. We actually don't care about that. Right now, all we're going to do is journalize those bonds. So 87,000 is how much cash the company received. So that's debit to cash. 90,000 is the amount of bonds that they sold. So that's how much they're going to have to repay in the future. The difference is the discount on the bonds. And notice that it gets debited. When we collected a premium for the bonds, that premium was a credit. But when the bonds have been discounted, that discount is a debit. Okay? That's why it reduces the amount of cash that we got. And going on to number 9, the same, let's see, is it the same company? I guess it's a different company. Oh, it's the one we saw up for number 7. We have to figure out the interest payment, the first interest payment to the bondholders. Okay, well, to do that, we take the face value, which again, it's 100 bonds at $1,000 each. Sorry, not speaking well today. 100 bonds at $1,000 each, that's $100,000 face value. Okay, $100,000. We take that face value times the stated interest rate of 6%. And then because the payments are semi-annual, we divide by 2. So these bonds are going to pay $3,000 a year semi-annual. Okay. All right, let's go on to number 10. Here we have a company that issued 150,000 in 10-year bonds. We have to journalize the sale of the bonds, okay? Well, we got $150,000 in cash, so that's a debit to cash. And we have bonds payable. So that's a credit to bonds payable. That's it. And if you don't believe me, there we go. And our last exercise is number 11. Okay, we have to figure out the interest payment. So this company issued $90,000 in bonds. That's the face amount. It has a stated rate of 8%, and interest is paid quarterly. Okay. So we could take $90,000, the face value, times the stated interest rate, which is the annual interest rate. And then we divide that by 4 because the company is making 4 payments a year. And that comes out to $1,800. So that's an $1,800 interest expense. And we pay out $1,800 in cash. And there we go. Okay, we are done with the exercise set. We have 4 problems to go over, and then we'll take a look at the course project. Okay, so we're doing 1, 3, 4, and 5. And actually, I think there are only 6 problems. Yes, so you're only going to have to do 2 and 6 on your own. Okay, number 1. This company borrowed $150,000. So this is back to a bank loan situation. Come on. Sometimes my cursor just disappears for some reason. I don't know why. There we go. Okay. The company borrowed $150,000, signed a 5-year note, 10% interest rate. The annual payments are $39,569. And that's basically it. So first we have to journalize the original transaction when the loan was made. It was a $150,000 loan, so that's how much the company received in cash. And the company now has a $150,000 note payable that it has to repay. So that's a pretty simple journal entry. For the final journal entry, the company is going to pay off that. Wait a minute. Oh, excuse me. It's not the final. This is the first payment that the company is making. It's going to pay part of the premium and part of the interest. And we have to figure out what part. So we know the amount of the payments is this $39,569. So that's how much cash the company has to part ways with. We have to figure out what portion of that is interest, what portion is premium that they're paying down. The way we figure that out is we look at the interest rate, right? So at this point, the company took out the loan at the beginning of the year. They have not made any payments yet. So they still owe $150,000 on this note, right? That is the principal. So we take the principal times the interest rate of 10% per year. That's how much of their first payment is going towards interest. The principal times the interest rate. The difference is going towards principal. So if we take the payment amount minus the amount that went to interest, The difference is the amount that goes towards principal. Okay. And in our journal, we don't need dollar signs because every entry is in dollars. So that's what our December 31st transaction is going to look like. We pay $39,569 that we have to pay every year. And 10% of the principal balance is our interest expense. The rest goes to paying down the actual note payable. Right, so that is our first problem. If there are no questions, we'll go on to problem 3. Okay, this says the company issued $100,000 of 8% annual bonds. And for $103,000. Okay. What is the total amount of interest over the life of the bonds? All right, so to figure this out, sorry, there we go. Okay, so to figure this out, again, we take the principal times the interest rate. And then in this case, we're trying to figure out how much interest is paid over the 5-year life. So we're going to take that annual amount of interest times 5. So principal times the interest rate times 5. That's $40,000 in interest over the life of the bonds. However, because the bonds were sold at a premium, the company collected an extra $3,000 up front. That offsets this interest expense by $3,000, right? Because that was money we got in. So yes, we're paying interest, but we got this extra money that creates a net decrease in the interest expense, if that makes sense. So again, $3,000 premium, we're going to subtract that from the interest expense. And that means our actual net interest expense is $37,000. In a similar way, for number 4, we're going to be adding to get our interest expense. Let me show you what I mean. This company issued 50 bonds at $1,000 face value each, 5-year, stated annual coupon 6% for $980 each. Okay, so what does this mean? Let's figure out the interest expense. First, we have 50 bonds times $1,000 face value each. That's a $50,000 total face value, right? Times 6% interest rate, and then times 5 years. So that's $15,000 of interest that we're paying. Okay, again, first we had to get the face value, which was 50 bonds times $1,000 each, gives us a $50,000 face value, times the 6% interest rate. That gives us the annual interest times 5, because we're paying this interest over 5 years. But one more step. The bonds were sold at a discount. So we didn't collect the full amount up front. That increases our interest expense since we got less money coming in. So we take that $20 discount because the bonds had $1,000 face value, but were sold for $980. So we discounted them by $20 each. Multiply that $20 by the 50 bonds that were sold. That's an extra $1,000 of expense for issuing those bonds at a discount. Okay, so that extra $1,000 expense we're going to add to the $15,000 we already calculated. And that means in this case, our interest expense is $16,000. Okay. So again, we had to get the face value of the bonds times the annual interest rate times the number of years. That gave us 15,000, but then plus the extra $1,000 of discount that, that was money we didn't receive. So that increases our interest expense. And that's how we got the 16,000. All right, so our last one, I believe, is number 5. It is, and I will tell you number 6 is very similar to number 5. The only difference is number 6 is semi-annual, and number 5 is annual, okay? But otherwise, they are the same. So let's do number 5, and then we will talk about the course project. All right. So here we've got a company issued $500,000 worth of bonds, 10% interest rate, 4-year term. And they got $540,000, which tells us the bonds were sold at a premium, which also tells us that the market rate has gone down, and that's why investors are willing to pay a premium to get our bonds. Okay, and in this case, we're going to use the straight line method, not the effective interest method, where we had to use the market rate and subtract the interest from the payment to get the, anyways, we're not going to do that. We're just going to do simple amortization. Okay, and the way we do that, first we have to journalize the original transaction. So we got 540,000. 500,000 of that is the face value, so that's bonds payable because they will need to be repaid. The other 40,000 is the premium on the bonds. Okay, so we separate that out. That is when the bonds are first issued. Then a year later, we are now having to pay interest on the bonds. So how do we figure that out? Well, we take the $500,000 face value times the 10% interest rate. And that means we're paying out $50,000 of interest. So that is an interest expense, and it's cash. Okay, because that's how we paid the interest, with cash or check. Oops. Yeah, that's right. That's right. Okay. Then part C is where we have to amortize the premium. So remember, the premium was $40,000 that we collected above the face value of the bonds. And we're going to spread that out over the 4-year life of these bonds. And we're going to do that evenly. So every year we're going to debit $10,000 of premium on bonds payable and $10,000 credit to interest expense. Okay, so what we're doing with the debit to premium on bonds payable is we are amortizing this credit up here. So after 4 years, it will be completely gone. And our interest expense here was a debit. We are now offsetting that with a credit. Again, we'll do that for 4 years. So even though the company's paying out $50,000, consider that 10,000 of that came from the premium on the bond, and that reduces our interest expense to 40,000. So in the next year, because we're doing these simple interest calculations, it's going to be another 50,000 interest expense and cash, and another 10,000 premium on bonds payable and interest expense. Okay, so again, you're going to have to do number 2 on your own. Let's see. Yeah, number 2 is going to be pretty simple for you. And you'll do number 6 on your own. With number 6, it's just like number 5. The difference is the interest is paid semi-annually. So you have to figure out what would be the amount you would get in 6 months. And what would be the amount you would need to amortize off of this premium every 6 months. Okay? So try to figure that out. If you run into questions, let me know. And we can now, if there are no questions at this time, we will go over to the course project, and I'm going to talk about the expectations. All right, so let's go ahead and do that. So let me just show you from the course homepage. You can scroll down to the course project module. I think I found a way to not have to do this in future semesters, but for this semester, there's one link that has the due date for the project. If you click on that link, you see that there's really nothing else there, just the due date. And then you can click on this link to take you to the actual course project. It's a long story why I set it up that way. It has to do with Turnitin. And I think I found another way to do it for the future, but for right now, that's how we're doing it. So let me just go back to the course homepage to show you one more time. Okay, from the course homepage, you could either scroll down to the course project module and click on the second link to go directly to the course project. Or if you go down to chapter 15, you have the links there as well, okay? That's when the project's due at the end of, not next week, but the following week. So you've got almost 3 weeks to get this done. It is a big project. I would say it's not huge, but it is gonna take some research. So I would recommend you get started, and that's why I'm going to go over what the expectations are now. So you can start working on it, and then you can let me know if you have questions. Okay, so what you do, once you open up the course project page, it tells us you are going to analyze a publicly traded corporation. So you're going to pick a company that has stock that is traded on a stock exchange. I recommend picking a US-based company. If you pick a foreign-based company that trades on some foreign exchange, or even a foreign-based company that trades on the US stock exchange, the problem is their currency might not be in dollars, and that's going to just make it harder to do your analysis. So I would recommend you stick with a US-based company, but they have to be publicly traded. Their stock has to be sold on a stock exchange. And then what you're going to do is research that company and analyze whether or not this is a good company to invest in. So I've given you some resources to help with that. We'll go through some of these resources in a few minutes. You notice there's Edgar, Yahoo Finance, Wall Street Journal, and Morningstar. You can use other sources, but these are all helpful sources for getting financial information about companies who are publicly traded. Now, Edgar is provided by the SEC, Securities and Exchange Commission, and it's not so user-friendly. So what I would recommend is follow these steps if you're going to use Edgar to get started. But a lot of the information you'll be able to find more easily on other sources, okay? There is a template you can use for this project. I strongly recommend that you use it. It is a PowerPoint presentation, and you are expected to include at least 8 bullet points on each slide. So let's go ahead and download it, and I can show you what I'm talking about. By the way, if you don't have PowerPoint, you can access PowerPoint through Duo. Let me show you how. If you go to Duo, click on AppStream MS Office, authenticate, and then here's PowerPoint. You can also use Google Slides if you want, or if you're a Mac user, you could use Keynote. Whatever program you use to complete your file, it's a PowerPoint type of file. Whatever program you use, make sure you save it in PowerPoint format at the end, okay? Sometimes students upload something in Keynote and I can't read it, or they give me a link to Google Slides, but then I don't have permission to open the link. So save your file in PowerPoint format and upload it to Canvas, okay? So let's go ahead and look at the template. Now, this is already formatted for you to make it nice and easy. This is the title slide. All you need to do here is put in your name and the month, date, and year. Then we get into the content from slides 2 through 9. That's where I want you to include at least 8 bullet points on each slide, okay? Now, bullet points are designed for the reader to be able to see up on a screen somewhere. So you don't need paragraphs, you don't even need complete sentences. You can use phrases as long as you're communicating the information. Short phrases are fine. And so 8 bullet points on one slide is not a lot of information, okay? For example, this first slide here with content is background of the company. And I've given you some examples. So for example, company's history, their position within the industry, their competition, recent developments. Now, these are just examples. You don't have to include all of this, but this is just to show you 8 bullet points. I mean, here's already 5 bullet points. So if I put company's history, let's say I'm doing, I don't know, what's a company? Lenovo. They make laptops. Okay. Lenovo started by acquiring IBM's laptop division. Okay, that is a sentence, but I could put position with within their industry, leader. You know, they're a leader in their industry. So it's not even a full sentence, right? Competition includes Dell and Mac, iMac, something like that. So again, doesn't have to be a lot of detail, right? 8 bullet points per slide. Okay, then we're going to summarize at least 2 news articles. So go out. I would recommend that you use the Hartnell Library, because if you go to the Hartnell Library, there's a link here. Here it is. And I search for Lenovo, or whatever company you're researching. Actually, I don't even know if Lenovo would qualify because I'm not sure. Let's check. If you're not sure if a company is publicly traded, typically if you just put in the name of the company and stock, sometimes you don't even have to hit enter and you'll see information about their stock price. Here, I'm not really seeing any details. Let's go ahead and hit enter. Okay, it looks like it is publicly traded. Oh, it's publicly traded over the counter. That means because their stock price is so low, $1 per share, stock markets won't allow their stock to be traded. If it's under like $5 a share or something like that, they kick it off their stock exchange. And you can still buy the stock, so it is still publicly traded, but you have to buy it, quote, over the counter. That's what this OTC stands for. So, okay, here's a company. They are publicly traded. We see a little bit of information about their stock. Okay, let's go back to the library. Okay, and so I did a search for Lenovo. Okay, here's an article about the company, about their laptop manufacturing. So let's say this was part of the research. I would encourage you to use articles from within the last year. This one's from 2022, so that's pretty good. So I'm going to go ahead and click on that link. It does say here no online access. So we might not be able to actually access this particular article, but let's just pretend that we could. And we were going to use this in our research. So then what we could do is go here to citation. And it gives us an MLA citation, which you can use. I tend to prefer APA. So you can just click on APA and you get the APA citation. I usually call it a reference. So then we can go back, go to the very last slide, and paste in our reference. Okay, it's already formatted for you. You need at least 3 references, so at least 3 different sources that you used for your research. And again, if you find those sources using the library, you just click the citation link, copy and paste that onto your references slide. Now, let's imagine that we were able to open this article. We couldn't, but imagine we could. Here, let's just go to news. Let's just pretend it was this article, okay? And we had quoted this information right here. Okay, I'm gonna take that as a quote. I go back to my PowerPoint, go back to my news items. If I'm including a quote here, okay, I have to identify it with quotation marks, and then I have to indicate the source of that quote. The easiest way to do that is put the author's name. And if we go back here to our reference, okay, there were multiple authors of that article. So we can just put the first one. Too many things to click on here. So the first author was Liang, and I'm going to put et al. That means and others. This is the proper way to do it. Okay? Et al, period. And then I'm going to put the year that they wrote that. They wrote it 2022. If I had a page number, it would be a good idea to include that as well, but I don't. Okay, so that's what an in-text citation looks like. Let's say that instead of quoting, I paraphrased some information, like Lenovo makes the best laptops. And let's say that that was also stated in that same article. Well, then, but it wasn't exactly in those words. I reworded it in my own words. So that means I paraphrased. I still need to cite the source. I just don't put quotation marks since it's not an exact quote, okay? And this applies for any slides. So whether it's on this slide or another slide, anytime you quote or paraphrase, include an in-text citation and a reference on the references slide, okay? So do that. If you have any questions or problems with that, feel free to let me know. The Panther Learning Labs, NetTutor, Get Tutoring, online services, they can help with this. And the librarians in the library, they can also help with formatting your citations and references. So don't have any anxiety over it. You can reach out to me or any of those other sources for help. So again, we want to include at least 8 bullet points here of information regarding to recent news about the company. If you find that you can't fit it well on one slide, you could add more slides. You're welcome to do that. Also, you can add graphics if you like. Technically, you really should cite the source of your graphics as well. I'm not going to be a stickler on that one, but try to cite the source of the graphics in addition. Okay, then we get into really the meat of the assignment. Here is where we start to analyze the financial statements. As it says here, you're going to look at the last 4 income statements for your chosen corporation. And you're going to look for any trends, like you see revenues increasing or decreasing, costs increasing or decreasing, any concerns you have looking at the income statements over the past 4 years, and any opportunities, like maybe you see, oh, the company has had, increasing profits over the next 4 years. They have the opportunity to pay out a big dividend, or they have the opportunity to invest in new products. So, this is really now where you're looking at the data over the 4-year period, analyzing it, and trying to figure out what are the good things that you see, what are the bad things that you see, okay? So now you're a stock analyst. And you might be thinking, well, where do I get the last 4 income statements? So this is where those websites might be useful. If we go back to, I'm going to close some of this out. I'm going to go back to the assignment instructions here. Again, you can go to Edgar. Edgar has all financial statements for all financially publicly traded companies, corporations. Let me restate that. They have all financial statements for all US publicly traded corporations. The website's just not that user-friendly. So if you want to use Edgar, here are steps. And you can find the annual statements for your company. And in the annual statement, you will find the financial statements. You can also get I should call it annual report, actually. You can get that also from the company's own website. If a company's publicly traded, go to their website. Usually in the investors section, they have all of their annual reports there. So that's probably going to be easier than using Edgar. But let me show you these other options for you as well. Those might be even easier. For example, go to Yahoo Finance. You could put in Lenovo. Okay, it brings up a whole bunch of things. They all say Lenovo Group Limited, except for the last one. Notice this first one says Equity HKG. And over here, the symbol is .HK. This tells me it's their stock in Hong Kong, on a Hong Kong stock exchange. We don't want that. We want US, just to keep it simple. This one says PNK. Okay, remember how I said that their stock, because it's so low, is sold over the counter? Well, another term for that is pink sheets. I don't know why they used to use pink sheets for these stocks for some reason. I think this is what we want. So let's click on it. Interesting. This says $20.23. In Google, it showed like $1.02, right? That the stock was trading at. Let's try it one more time. Let's try Lenovo again. And let's try the second one that says PNK. Oh, I see it has a different symbol, so maybe it will be different. Yeah, this is the one that we saw earlier, $1.02 per share. I'm not sure what's the difference. Maybe Lenovo has two different divisions. So we might want to research that a little further, make sure this is the correct division. But for now, this is okay. So what we see is that the stock is currently trading at $1.02 per share. So we see information about the stock. We can see the price earnings ratio, the earnings per share down here. That's not that, I mean, that's a little bit of useful information, but there's a lot more that's going to be helpful to us. For example, let's go to, well, let's look at chart. Let's see, does it show us? Okay, it shows us how the stock has done over time. This is useful. You can look at the entire life of that stock. You see how, oh, it's gone up and down, but it's always been under $2. Interesting. Interesting. We can go to historical data. That'll give you specific amounts that the stock is traded at over time. Oh, let's go to statistics. This is going to be useful. Statistics gives us the PE ratio, again, the price sales ratio, price book ratio. What else do we have in here? Return on assets, return on equity. There's a slide for ratios, financial ratios. This is where you can find a lot of those. So this would be very useful. So the statistics link would be helpful. If we go to financials, now this is really helpful. This is the income statement, in this case for the last 3 years. Sometimes you'll get the last 4 years, but in this case they only gave us 3. You could also see the balance sheet for the last 3 years and the cash flow statement for the last 3 years. If you're on quarterly, it's going to give you quarterly statements, so make sure you're on annual. And this is where you can look at, for example, with cash flow, you can see how has their annual cash flow changed over the last 3 years. Notice it says here all numbers in thousands. So this is $2 billion in operating cash flow in 2020, 3.6 billion in 2021, more than 4 billion in 2022. This is interesting. I don't know why their stock is so low if they're generating so much cash flow. Anyways, you could look at investing cash flow, which is negative. Financing cash flow is negative. Maybe that's why. So again, you've got 3 different financial statements and 3 years worth of data. So that's useful. You could also look at the analysis page. Oh, okay. I guess you have to pay for that. So don't pay. You could always find the information somewhere else. So that's Yahoo Finance. Just for comparison, let's take a look at Wall Street Journal. There's also Morningstar. But I don't want to spend all day on this. So let's go here. I'm going to go search. I'm going to go Lenovo. Search. Okay, we want, I think it was the GF, right? Why is it not cooperating? Okay, there it goes. Yeah, this is the right one because it's $1.02. Hello, Maria. I'm going over the expectations for the course project. So make sure you go back and watch the recording later. I already covered the exercise set and the problems. Or no, did I do? Yeah, did we do the problem set? We did. I just forgot, but yeah, we did. Okay, good. I got scared there for a second. Okay, so again, Wall Street Journal, very similar. It's got some basic information about the stock. If you go into financials, again, it's got income statement, balance sheet, cash flow statement. Here, they're giving us 5 years. Nice, we only need 4, right? For the assignment. Let's see what else. Research and ratings, profile. So again, you've got some nice information through Wall Street Journal. You could also go to Morningstar. You could look for other sources of information. And again, you can always go into the company's website, get their annual reports, and find their financial statements there. I would start with the most recent annual report because sometimes it'll show 4 years worth of data. And the statement of stockholders' equity did not show up on Wall Street Journal or Yahoo Finance, but you will find it in the company's annual reports. And that is something you're going to need as well. Okay, so don't wait too long to start doing your research for this particular assignment. It is going to take a while to find the data and do the analysis. So again, we've got one slide where you include 8 bullets where you are summarizing what you saw on the income statement, what kind of trends, issues, concerns you saw. Same thing with the cash flow statement, same thing with the balance sheet, same thing with the statement of stockholders' equity once you find it. Okay, and if you have trouble finding any of these financial statements, feel free to reach out to me, I can help. Then we get to the ratio analysis slide. This is where some of those ratios would be useful. We saw them with Yahoo. I would imagine somewhere here. We might find some of those ratios. I don't know, I'm just playing around here. I'm not really sure. I would imagine they're probably here somewhere in Wall Street Journal data. Maybe, again, it might be a case where they want you to pay extra money for that. Okay, so if you can't find it on one website, again, you could always go to the company's own annual reports, or you could, you can calculate the ratios on your own, is another option. And then the next slide is recommendations and justification. And this is where you look at your entire analysis that you've done of the company and explain why you think this is or is not a good investment. So provide 8 bullet points explaining why this is or is not a good investment. The final slide is where you include at least 3 sources that you used in your research. Again, anyone that you paraphrase or quote, you should cite and reference. So you might have more than 3 references, that's fine. Again, if you need extra slides, you can add them. Once you're done, save your file in PowerPoint format. Come back here to the assignment. Let me see if I can switch over to student view. Okay, and then you should have a link down here to be able to submit it to Turnitin. You don't need a Turnitin account. You just submit it right here. It'll automatically check the PowerPoint. It might give you a matching score. Don't worry, as long as you didn't plagiarize, don't worry about the matching score. It's just a reference tool for us instructors, but just because you have a high matching score does not automatically mean there's any plagiarized material. So then that's it. Once you submit it, you're done. I'll grade it, and you get up to 10 points. So it's 10% of your course score. Okay. So does anyone have questions on the course project or anything else before we wrap up this session? No? All right, then. I wish you a good week, and we'll see you next week. In the meantime, email me if any questions come up, or just drop into my office hours. All right? All right. See you later.
Okay, goodbye, Mr. Williams.
Okay, bye-bye.